Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, you can find us, of course, at zinniawealth.com, ZINNIA wealth.com. All right, so here we go. You put 100 people in a room and you say, all right, how many of you, raise your hand if you've saved $1 million for retirement? Of that 100 people, how many people put their hand up? The answer is 3. 3% of Americans have saved $1 million for retirement. Are you feeling a little bit better now? Okay.
Yeah.
So here's what we're going to do. We're going to talk to you 97%ers, okay? All right. So, Sharice, somebody walks in, let's say, with $500,000. That's a little bit more common. And then you have another person who walks in with $1.5 million or $2 million, like you've said. Is there a lot of difference in the planning between the person who has $500,000 and the person who has a lot more?
You know, it's funny because categories do walk into our office. So we'll see the 500, the 750,000, and then we'll see the 750 to the 1.2 million, and then we'll see that 1.2 to 1.8, and then you go from 1.8 to 3 million. So there are different strategies for the different segments, right? But it really just depends, because actually it's really not that much of a difference between if you have 500,000 or if you have 3 million.
Interesting.
Well, yeah. What it's all dependent on is your income and your income needs and how much you are going to spend, right? So if you come in with $500,000 to $700,000, but you have a good Social Security, you have a good pension, what we end up finding out is those people don't even need to touch their money.
Wow.
Right? Which is very interesting. And then they're forced to touch their money at the age of 73 when it's finally doubled or likely doubled, if not more. And now they're forced to pull money out, and then their tax bill goes up. And they're like, I don't even need this money. But it doesn't matter whether you need it or not. You're forced to pull it out. And so that person will be invested just like our $1 million client and probably our $3 million client. Now, if you have 500 to 700,000 and you have Social Security and no pension, we might invest a little bit differently than if you had $1 million or to $2 million. And the reason why is that we probably need to plan more for safety and income. So it is a little bit of a different strategy. Safety and income and protecting more is going to be key if we're living off Social Security, and now we got to take 4 or 5% from that investment. So we got to be extra cautious when it comes to that. Even if you have 1.5 million and you just have Social Security coming in, both types of people probably have their homes paid off and don't have any debt. But we still want to be cautionary about how much we have at risk, especially if you need, 40 to 50 grand from these types of accounts, 30, 40, 50 grand. So, but I will tell you this much. Most of our clients go into 6 to 7 baskets. And in those 6 to 7 different baskets, that's not just a 60-40 portfolio. One of the baskets might be a 60-40 portfolio. So it's a small part of your basket. But what will happen, depending if you have a 1.5 million or 700,000, you might have a higher percentage in some of these 7 baskets than the other person.
Yeah, you're kind of saying exactly what I was thinking here, is that the person who has $500,000 to $1 million is going to be more focused on risk and protection and income. But that person with a lot more wealth will have those same concerns. But are we talking more about tax strategies there than we would be maybe with the other person?
So honestly, our tax strategies are for everyone. Whether you got 500 grand or you got $5 million or $20 million, whatever the number is, our tax plan is for everyone. Because if you do have 500,000 and you're not going to plan on spending it to later, 73 or 75, for example, because maybe you do have a good Social Security and pension, we don't want that 500 grand to turn to $1 million in all taxable money. So we'll work on that tax plan for people who have that $500,000 and above, because it's probably going to be necessary. Now, if you're going to spend most of your money or spend every dollar based on your last breath, then there probably is not going to be much of a tax strategy, right? And again, we can't really predict that either. And but tax planning is key for everyone, because Uncle Sam, there's no guarantee taxes won't go up in the future. And I certainly don't think they're going to go down anytime soon, especially in the next 20 years. And so we want to make sure that the legacy to the kids is not going to be hugely taxable either. And then the surviving spouse gets really hit hard with taxes because, the standard deduction gets nearly cut in half and your tax bracket goes up. and you still need your income, and you have 25% less income because you lose a Social Security. So we got to talk about that tax plan too. So there's different phases of our tax plan and who it's for. And if you said, you know what, I don't care, Charisse, and my kids can disinherit the tax problem, then that's fine too, right? But we're at least going to show you.
One of the things that is kind of fun that you and I have been doing this show for 13 years, I can think about some of the conversations that you and I have had. And I remember finding an article one time, and some of these people were actually in the villages in Florida, and they were talking to people that had $1 million. And they said, how are you doing with your retirement? What are your concerns? And it didn't make any difference if they had a pension, if they had, inheritance, whatever they had. The concerns were the same. People are people. People who have $5 million are still worried about running out of money.
They are.
People who have $500,000 are worried about running out of money.
They are.
So you have to solve the same problem psychologically for people as you do whatever kind of wealth that they have, don't they?
Yeah. And it's so interesting because 20 years ago when I got in this business, I never would have thought that, right? I thought, the more money you save, the more secure and confident you were. And most people retire and they're not spending enough money because they are worried about running out of money, right? And so our job is to show you a plan, a written plan. 1 out of 5 retirees have those things, and we do provide that here, which will help with the confidence throughout the next 30 years. And we adjust it every year if it needs to be adjusted, and you kind of see where you're at. And it's important to have that.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com. That's ZINNIA wealth.com. When you get to the website there, you're going to see a gold box that says Complimentary Retirement Consultation. Just click on that, and we'll have you put a little information in there, a little contact information, and then our team is going to reach out to you with basically this question. What are you concerned about? How can we help? And we'll start a conversation there. You can also bypass that and just give us a call and start that process that way. It's 833-368-3680. 833-368-3680.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.